although property values have come down a lot. Interest rates went up. Our cost of capital went up 500% in 2022. And when that happens, it shocks the industry. Nobody saw that coming. Everybody was predicting a recession. Everybody was predicting inflation, but nobody saw interest rates. Interest rates have never, ever historically gone up 500-600% in a week or 2 weeks. That's what happened in the spring of 22.
Hello, everyone, and welcome back to another episode of Path of Progress. I'm your host, Alex Kononov, and today's guest is someone who's done it all in multifamily space and has the scars and wisdoms to prove it. Tate Siemer is a real estate investor, serial entrepreneur, coach, and a podcast host. Over the past several years, he's led 10 multifamily syndication as lead sponsor, with plenty of wins and a fair share of painful lessons. Tate brings no fluff perspective to what it really takes to succeed in the business. And today we dive deep into what most people don't talk about, the dark side of syndications, the risk, the pressure, the investor expectations, and how to survive and grow through it all. Yep. Tate, welcome to the show.
Alex, this is awesome, man. We're both wearing black t-shirts for the dark side today.
Yep, I think it's meant to be like that. So Tate, let's rewind a bit. Let's start from the beginning. Walk us through your real estate journey and how did you discover multifamily space?
Yeah. So real quick, early years, 2006, got into single family house flipping in Salt Lake City, Utah, became a realtor, worked with investors. The crash happened, got out, had a few rental properties myself at the time, really struggled with those just from a cash flow perspective, never really hit a stride. Swore off real estate permanently, never swore never again would I do anything ever with real estate. In 11 October-ish, my best friend and business partner, Carl York, came to me and basically said, hey, dude, like, you know how to flip properties, right? I know how to fix properties. And he is a master mechanic and construction manager and everything else. And Carl York is a gem that changed my life in 1990. He was my first boss in photography at the ski resort at Snowbird in Utah when I moved from Cincinnati to Utah, which is another story. But so we started flipping houses in 2012 and we did that for about 7 years. And we did a few other things too. We did some land entitlement deals. We built some high-end luxury townhomes. What else did we do? We basically flipped probably 35 homes in Salt Lake County, mostly in let's say the median household range. Mostly we did do some $1 million houses back then. That was a lot of money. We would buy stuff for 600, 700, put 180 into it, sell it for 1.2, that sort of thing. And then we had a 12-unit apartment community complex building fall in our lap, literally, pretty much, from a wholesaler that had brought us a few other deals, the luxury townhomes that we built in particular. And we ended up doing this 12-unit deal. It was a total revelation to us in terms of what it looked like to have cash flow and rents and a P&L, like T12, rent roll, like all the stuff that became what we ended up doing with Greenlight Equity Group. Fast forward, we now own 8 properties. We've done about 13 deals, I think. Probably the average size deal is 100 units. Let's say we've done some 50 units, we've done some 70 units, we've done some 179 units, we've done 84 units.
Tate, you jumped right away from hey, I'm flipping houses.
I'm doing the weave, man. It's all about the weave these days, right? Like all the smart people do this weave thing. So go ahead, Alex. Sorry,
but we want to make sure our followers follow along, and we can dive deep into small starting steps, so we can understand where you're coming from better. So you understand that flipping, you like flip. Why did you switch? I understand you had this falling on your lap, but did you decide, okay, I want to focus only on multifamily? You stopped doing flips and everything else after that?
Yeah, that's a great question. Yeah, I caught a vision for what it would look like to basically take the flipping model, the value add model, and apply it instead of 1 unit at a time. Then we did 12 units at a time, right? And then we did our next project was 20 units up in Clearfield, Utah. And then the next project, we went into Columbus, Ohio, and we bought 70 units, right? And this was 2021. So like
So
hold on. So basically what happened was with that 12 unit, which literally we did not see coming, we didn't plan on, it fell in our lap. That's what I mean when I say it fell in our lap. Like it was unexpected. When we saw what it looked like to underwrite a project that had income and rents and target rents and a value add component that was not just based on how much money we were spending on, you know, the granite countertop in the single family house that we were flipping, but rather the 12 Formica countertops, let's say, and new Formica if it's a, you know, a budget apartment, right? I caught a vision, Alex. That's the best way to say it. And I started going to conferences. I met some really key people in my life, and we'll talk about that. But it was it was kind of like you don't know what you don't know when it's coming in life, and basically that it was a the 12 unit was life changing for us and was really a blessing, honestly.
so it was location was still Salt Lake County, right? Where you
Yep.
operated mainly. And tell us about structure on your first deal, on multifamily deal. Was it a JV kind of operation?
Uh, no, we bought it with hard money. Let me think about that. Yeah, we bought it with a hard money loan, right? We needed a down payment for that loan. So I'm trying to remember the numbers on this. It's been a second. It was 2018 ish, and so I think what ended up happening was we bought it for, gosh, I should have brushed up on these numbers. Let's say 800K.
Just a ballpark.
Yeah, let's say 800K. All right, let's say 1.1. So we got a loan for, I think it was about a million. We needed 150,000. We didn't have it because we were deep into some other projects that we were building, new construction. And we found a single investor that basically gave us a personal loan on $150,000 who knew the hard money lender, right? This is all relationships from our single family days. And that guy invested. He made really good money. The hard money loan was easy, fast, you know, like all I had to do was call my guy, Tate's what's the address, send it to me. He Googles the address. Back then it was Google, you know, like, and he said, thumbs up, let's go. And so yeah, that's basically how we structured that thing, man. It was anything but a syndication. It was not even close to a syndication. We didn't even know what a syndication was. We didn't know what capital raising was. We didn't know that was in our future. So yeah.
You cut your teeth on small renovations and flips, and you got the same business plan on a hard money, and you just apply it here. So what was the business plan? Did you plan to refinance on it, or you just sold the property after?
Yeah, we sold it. We so what we did, there were 12 units, 6 of them were vacant, 6 of them were month to month, right? There were no leases, there were no financials. The whole building needed to be renovated. So what we did was we let the month to months expire. We didn't evict anybody. We gave them notice and let them know that they were going to need to move out because the place was in shambles. Like it was no bueno. It wasn't like there was mold or uh, anything like. We actually found out there was meth, which is a thing in Utah that you test for, which we knew about all along in Utah, but it's not really a thing in other places. But there was one or two units that were actually contaminated with crystal meth that we found out because the buyer that ended up buying it tested the units, so we had to mitigate those.
So
Yeah,
you test units in for meth?
yeah, yeah, yeah. So like a lot of people, as part of their due diligence, will bring in a meth inspector and they will swab the walls with chemicals to see if there's meth in the, and it's legit toxic, man. It's like
Wow.
if somebody's been smoking meth in an apartment for hours and hours and hours, it's like it leaves a residual that apparently is very toxic. So that was something new to us. We had actually, I don't think we had ever dealt with a meth house before. We had probably passed on a number of meth houses. It's kind of a deal breaker, really, because the decontamination process is insane, and you got to
Why you have
pass.
to strip it all
You have to,
to the studs?
yeah, yeah. You basically you have to test, see what the levels are, and then you do like all these mitigation. Like you scrub the walls. I've scrubbed walls by hand, man, like with bleach and like rubbing paint and like, and you basically just clean it, clean it, clean it, clean it, clean it till somebody can come in and legit test it and make sure that the levels are no longer there. And so whatever it takes is what it takes. And it's not, it's, yeah, it's something that like most people outside of the state of Utah don't know about. Uh, so
Yeah, I feel. Your first multifamily deal, you have to scrub walls for meth contamination. You're like, I
You
love
know,
this journey.
yeah, yeah. No, I'm trying to think. I don't think I scrubbed the walls at that one. We did have to mitigate it though. So we brought in a professional mitigator, but no, I've scrubbed
Okay.
walls at a few properties over the years.
Okay, but that's fun experience. Okay, so how long did you have it? How long did it take you to stabilize your first deal? And what did you learn from there?
Yeah. We had it the better part of, let's say, a year and a half. What we did was I mentioned there were 6 tenants, right? Month to month. They were paying half of what we ended up charging in rents there. They were paying like, let's say, 500-600 bucks. And we renovated head to toe, all brand new units with brand new everything, appliances, windows, mechanicals, floors, everything you touch, fixtures, faucets, and paint, of course, everything, wall coverings or window coverings. We did the exterior, we did landscaping, we painted the brick, we et cetera. We did the roof. We did everything to this building. So we doubled the rents. And when you double rents, you double the income, right? What happens when you double income in multifamily?
Your NOI going up.
And we were also on a wave of appreciation at that time, right? So we
Also, you
sold.
changed mechanicals, right? So your
Yep.
expenses went down as well because you have less repairs and everything is brand new and shiny.
Yeah, and what's funny, Alex, is like we never got financials to begin with from this property, so I don't even know like what the. I mean, I guess we could have gone to the electric company, but I don't even know how much we ended up saving on mechanicals. The key thing is in Utah, it's hot, man. Like in Salt Lake City, the summers are hot, so you have to. I think we did twin splits. I think that might have been our first twin split scenario, if I'm not mistaken, which is the newer air conditioning technology that a lot of people use these days with the wall units essentially. So anyway, long story short, we made about 300 grand on that deal. For us, that was big money. It was four, let's say at that point, 3 to 4 times what we had ever made on a deal. And we did have at the same time we were doing a house that we ended up selling for 1.4 million that we did about as well on. But anyway, long story short, like I was off to the races in my head. I went to conferences. I met people. I found my mentor, Corey Peterson. He told me to start a podcast that became the Apartment Gurus podcast, which is still around. It's a podcast for lead sponsors and operators. And I'll rewind for a second and just summarize that what that led to. I mentioned the 20 unit in Clearfield that we ended up doing. Those were our 2 Utah multifamily deals. And then we decided that if we were going to scale up to 100 plus units, which is where that's where syndication starts, right? That we needed to go to a market that was affordable. In Utah at that point was becoming less and less and less and less affordable. And it's now very unaffordable, which is a problem. And so we went to Columbus, Ohio. And I'm from Cincinnati, Ohio originally. That's not why we went there. It was a convenience. But we ended up following the advice of Neil Bawa, who a lot of you probably know. And if you don't know him, I highly recommend getting to know Neil online. He runs incredible data-driven webinars. He's a data analyst. And his pick for 2019, no, for 2020, I think, was Columbus, Ohio. That was his market pick for like the best market to go into for the upcoming year.
He's such a strong marketing guy that I think every single real estate investor gets his email. I don't know how he does it, but everyone in his mailbox.
Yeah. Neil's a stud. He's been on my show 3 times, and he's the best in the biz as far as if you ever have a chance to see him speak live or go to one of his webinars, but if you ever have a chance to see him speak live, you have to go. Like best ever conference, he almost always speaks, and you'll be laughing and you'll be on the edge of your seat. You'll be laughing the whole time though. He's as funny as he is smart, and we owe Neil a lot in our business for what we've been able to do.
No, I love it. I think it's important for our listeners to understand there is a path here, right? You tried your own project, you tried smaller multifamily, tried another one, but in the same time, you decided, okay, I have to educate myself more. I have to surround myself with people who's doing it on a larger scale, because to break it from a flipping to smaller residential and go right away to 100 units, it's very tough and very toxic on your mind because you need to compare those numbers, and when you start comparing, it's everything crumbles. You get an analysis paralysis. But in your case, you spent some time educating yourself. How long did it take you go from small multifamily, 20 units, 17 units, to larger 100+ doors and syndications?
Yeah, we were finishing up our 20 unit, the second project in Utah, when we started buying in Columbus. The first project we bought in Columbus was 70 units, which ended up being our worst deal ever, which we can talk about a little bit. But then we bought 179 units that we still own, and we're about to list. I think the GPs are trying to figure out what we're going to do with that property, but it's been performing well. And then we bought, long story short, we bought about $50 million worth of real estate in multifamily apartment communities in Columbus in, 18 months. So
In 18 months.
yeah.
Okay.
Yeah. So we went from basically zero. We had the 12 unit was done. We had the 20 unit in progress, but we were technically in debt. So, I mean, our net worth, our assets under management was whatever. It was $2 million, So we went from $2 million in AUM to 50 million in AUM in 18 months. And that was it. You got to put this in context. That was in 2021, right? Now, fast forward, we all know this, looking back, the deals that were done in 2021 and 2022 have suffered, right? And we're going to get into that. But, between, let's say, beginning of 2021, middle of 22, we did about 50 million, and then we got about 30 million more.
What is downside of scaling so quickly? Tell us a little more about it, because for me, it's scary going from zero to, I don't know, 1,000 of units right away. What was your feedback on this?
We talked about internally, go big or go home. Like, that was our motto. That was straight up. We were 1,000 units or bust in a year. It was myself, Carl York, and a third partner, and who ended up working with us for a couple years, and then ended up not working with us after a couple of really bad deals. And basically, our vivid vision that we wrote together was all about going big fast. And you got to keep in mind, this was post-COVID, and it was pre-interest rate crisis, right? So the environment was and everybody was investing, right? Because LPs were stoked. They were investing in 5-year projects that were paying off the 5-year dividends in 18 months, right? A year and a half, they would get their returns back, and they could reinvest, and they were getting 100% depreciation, and it was like gravy then, right?
Everyone was high on this hopium that it's like this is just never ending fun trail of syndications. Let's do it fun. But what was your particular role and your partners in syndications?
Yeah. Let me rewind for 1 second. There's something that's super important to mention that I think can't be glossed over. I mentioned Corey Peterson. He was the big kahuna. A lot of people know him. Celebrity in the space. He was my personal mentor when we decided to go large scale multifamily. And there's no way we would have started touring properties and making offers on properties, 100+ units, if Corey Peterson hadn't been in my ear telling me what to do, right? He's also the reason I started the Apartment Gurus. There's no way we would have gotten $50 million worth of real estate in 18 months if I hadn't hired a coach. And I can't even remember what I paid Corey. It was probably like $11,000 for a year of group coaching, right? And it was all in person. It was actually pre-COVID when I started working with Corey, because we didn't even have Zoom meetings back then. I had to fly to Phoenix to work with him. I flew to work with him on a one-on-one day. It was just the two of us for 24 hours, and it was amazing. And we'll probably touch a little bit on coaching and mentorship down the line. That's something I've done the last 3.5 years, is I've coached other multifamily investors. But I don't want to gloss over that.
I think it's important for people to understand you not just jumped from one thing to another.
Yeah.
You had someone on your back corner helping you, guiding you through this process. Because you're not just Superman, just, hey, I'm going to get millions of properties tomorrow.
That's right.
It just doesn't happen this way unless you really have someone who has this experience in your corner, in your team, helping you, guiding you through the process.
And especially back then, man, you got to keep in mind this was 2019, 2020, and this was pre like the ubiquitous nature of like all the information, AI, like ChatGPT. This was ChatGPT we didn't even hear about for another 3 years at that point. So back then, in the good old days, having a mentor or a coach telling you what to do was the best way that you could leverage your, 20 grand or 25 grand or 30 grand or 11 grand. Like, and I've always said that, like, Tate, how do I invest my first 25 grand? Well, hire a mentor, because you're gonna shorten your timeline to get going from point A to point B by 5x, 8x,
I mean,
10x.
I mean, you're saying it's back then, but it's the same place here. AI is just a machine that can help you to get some guidance,
Yep.
but really, is it saying truth? You don't know. How can you
Right.
prove it? But if you have someone with real life experience showing and proving and actually guiding through his experience to your experience, that's invaluable. I think we're gonna come back to coaching later on, but for our listeners, so your mid step was coaching, get networking, coaching, and with this help, not only mental, right, but also showing the ropes and getting these connections in line. Actually, what means a lot to get to the finish line, especially it's because sign an LOI is just one step, but get to the finish line and go through the steps. This is what matters.
Alex, can I just say, I've thought there should be a book that starts at the point of writing your LOI to getting the keys to the apartment community. Because what happens between those 2 points in time is insane, man. You're talking about like literally hundreds of moving parts. And you asked earlier what I do, what my role was in these deals. My role was the captain of the ship. I was like, and everybody knew that. That it was stated in our documents, in our vision, and I was the boss. I found the deals, I underwrote the deals, I found the investors most of the time, although I did bring in partners, and Carl found a lot of investors, and our third partner found some investors. We found a key investor on our Clearfield deal that we brought into Columbus out of Utah. But guarantors, you have to have a producer of the movie, and the director is not the producer of the movie, by the way. The director's more of like a tactician. They still have the vision that's informed by the producer. The producer's in charge of everything. I almost swore there. You do everything.
You need operations guy who knows how to finish.
Well, it's
One
not
guy can have
operations. It's
vision.
not operations, dude. It's executive. It's executive ownership. It's ownership.
Yeah.
Yeah,
Ownership.
it's executive. And your operations is your management, your third party
Yes, you're
management,
right.
asset management, your capital raisers, your admin. That's all your operations. There has to be the guy at the top, and that was me. Always, every single deal we've ever done, to the point of closing. Now, when we close the deal, then we bring in our property managers and even our asset managers. So I take my foot off the gas. I'm on the GP meetings every week on our deals. We still own, I think, 8 or 9 properties right now. And I don't mean to be ambiguous. We're trying to sell and refinance a couple of them, and we've got one that's in an auction, quite frankly, in Oklahoma, or in Lawton, Oklahoma. That is a deal we never should have done. But so let's say we own 8 properties right now. I think we've done a total of 12 deals or 13 deals that I would call syndications, that were syndications. So they had PPMs, they had operating agreements, they had LP investor, we had legal teams that drew all of that up, right? We bought them from commercial brokers usually. And we could do a whole show on how I set up Columbus, Ohio, broker relations, like, why we're such experts in Columbus now and why we love Columbus. Like there's a whole big set of conversations there, but we'll stay focused on kind of the path. And I know you wanted to get to some of the dark stuff and
I think we already touched it a little bit, but I think at this point, I want to dive deeper into it.
Yep.
I know it's getting sensitive topic here,
Sure.
but I appreciate your openness on this.
Yep.
So let's dive deeper into dark side of syndications. I really want to understand what went wrong on some of the operations that you're saying. Yeah, I shouldn't bought it. Hindsight 2020, would have, should have, could have. But share with us where did those deals went south and why it happened, since you are the captain of the ship.
Yep.
Let's dive deeper into let's first deals that you already told it's already went south, and then I want to touch a little bit on second deals that already what's going on with it.
Yeah. Well, let's just talk about the industry for a second.
Sure.
And so Neil Bawa, who we talked about, he said probably a year and a half ago to me, he's like, Tate, for every syndicator that has 10 deals right now, 3 or 4 of them are going to like go completely upside down and everybody's going to lose everything. So 3 out of 10.
Ouch.
For the best syndicators on the planet, and that's happened, right? That has actually happened. Like, I don't know if I don't know if those numbers are exactly right, but I know there's guys in this industry that I respect and learn from and look up to that have LPs that have lost everything. And that's a reality, right? That is actually happening. The percentage of active deals that were bought in 21 and 22 that are paying preferred payments right now to their LPs is low, really, really low. And if they're getting paid at all, they're getting usually a partial pref payment. Now, of course, most people are set up so that that pref accrues, and they will make it up ideally when the property is sold. Although property values have come down a lot since interest rates went up. And that's like the elephant in the room here is our cost of capital went up 500% in 2022. Like that's a thing, man. And when that happens, it shocks the industry. Nobody saw that coming. Everybody was predicting a recession. Everybody was predicting inflation, but nobody saw interest rates. Interest rates have never, ever historically gone up 500-600% in a week or 2 weeks. That's what happened in the spring of 22. So if you want to zoom in now on us, long story short, we had a deal that we put under contract in the spring of 22. That was our biggest deal ever. It was $27.5 million acquisition in Columbus. And we needed to raise about $11 to $12 million for it. And we knew that we were going to have to raise institutional equity, pref equity or JV equity, not LP equity. We were going to bring in a big chunk of money from a family office or a private investor or whatever that would be a pref equity piece or a JV equity piece. We were going to give away a fair amount of the deal to do that. And I knew what I was doing with that. I had relationships in place. So did my partners. We basically started conversations early on about, hey, we've got this deal. We love it. Here's why. It was a killer deal. It was a killer deal in the pre-interest rate hike environment. Let's put it that way. And basically we got an offer from a JV partner that I turned down because he wanted 90+% of the deal. He wanted like full control. He wanted voting rights. Like he wanted us to give everything away.
Everything.
Yeah, we was still made a good chunk on the acquisition fee, blah blah blah, like, which, whatever. Like, so we said no, thanks, we'll stay in touch, but I knew we had other options. That I thought we had other options at that point. Well, guess what happens? Right, the interest rates go up in, I think it was April or May, like late April of 22. The Fed starts hiking interest rates big time, like as fast as they can. And at the end of the day, we were a month or 2 months into this deal, and interest rates had destabilized in a way that has never happened before. Equity went away. The pref equity sources went away, and the JV equity sources went away. They put their pencils down and they closed their books, and they said, we're not going to do new deals until we figure out what the heck's happening. And we all know what's happened since then. Properties have come down in value. Cap rates have decompressed, right? Because when your cost of capital goes up, your cap rates decompress, so they go up. Cap rates go up, meaning your value of your property comes way down, meaning that if you have to get out or refi, sometimes you can't. And that's why you end up losing 3 or 4 deals out of 10 that you bought in 21 or 22. Now, we have sold a deal that we lost LP capital on. That was our first deal, our 70 unit. We also sold a deal in Columbus that we returned about 9% as opposed to about 19 or 20% that we were projecting. But we got out early for our investors because we wanted to protect them. So we had to make a tough call, but we returned a much lower return than we predicted. And other than that, we haven't lost properties. Like I don't have anything that I've lost everybody's money on, except for that 70 unit. And that one we're still, we're working with the investor, we're working with the GPs, and you and I've talked about this offline, Alex, you know all about this deal, and it's a mess. It's an absolute mess. The GP group is disintegrated and pointing fingers at everybody else, and I won't throw anybody under the bus. I also don't have anything to hide, right? You can probably tell that. But in order to just stay pro, I guess, I'm not going to name names. I'm not going to implicate people, but some bad stuff happened on that deal, and the LP investor that I found through a friend of mine that I leveraged a relationship with and who trusted me, and then the investor trusted him and trusted me when I said this deal's a good deal, he lost his money. And the way that the GPs have handled the distribution of the proceeds from the sale means that he lost all his money. And so it's a huge, huge, huge bummer. Now for him, I don't know him very well. I hope that it wasn't as impactful as it would be for me to lose that kind of money, but it was a lot of money, man. This was a 6 million. Let's see. I'm trying to remember our acquisition price on that one. It was our very first one in 21. But let's just say it was, the better part of $1 million equity piece that we essentially got from one investor. We had a few other sources. So
Wow.
yeah, so it was painful, dude, and it is painful. And that's like the dark side of syndication in 21, 22. And that's a lot of people got into the business in 21 and 22 and cut their teeth like we did, like I did, and have had a lot of things go really, really badly. And that's industry wide, right? And I'm not saying that I'm not responsible for the failures that we've had, because I was the captain of the ship. And when the captain of the ship goes down with the ship, when the ship goes down, it's my ship. And I don't shed any responsibility for any of that. However, it's investing, and you can't tell the future. And you can't, a 500% interest rate hike is a nuclear bomb in an industry. So yeah, go for it.
No, I understand that, but listen, it doesn't matter how much money. If you would invest 50,000, 100,000, it would be probably the same painful. It's hard-earned money, and when you're trying to invest in brick and mortar, especially when since 2020 it was overpopulated on social media, it's sexy to invest in multifamily. It's a no-brainer. You can't lose money. It's brick and mortar,
Yep.
and you have tenants paying you rent. It's a different game when you go into details. So. Before we talk about the investor and relationship and how did you manage to talk to him about it, tell us at what stage syndicator decide, okay, we have to sell it at loss or lose it? What actually
Yeah.
happened there in terms of financial?
Great question. That is the question. So what happened with that property? It was 70 units. It was a portfolio of 3 different properties within about a quarter mile of each other on a corridor in Columbus, Ohio, that was not gentrifying or progressing economically, and since then has not at all. It's a very rare scenario in Columbus to have an area that's just dead, and that's what this area was. And it was Class C distressed, which is what everybody was going for back then. And they were all 1-bedroom units, which meant that our tenant base it was the lowest paying tenant base in Columbus, Ohio, and they were almost all single people that, quite frankly, probably were not employed or were not gainfully employed, which is why they were living where they were living, which was in our building. We brought in what we thought was a great property manager to start. They dropped the ball, couldn't get anything to happen. Vacancy was horrible. Target rents were not even close. And by the way, our CapEx budget was blowing up. I missed that. I missed on that by a lot. because it's an old building, and you start peeling back layers of the onion in an old building, and all of a sudden your CapEx budget's inflating. So we had a lot of things going wrong fast. We brought in a second property manager that we had working on one of our other properties that was a Class C property manager. And with Class C property management, you get Class C service, quite frankly. However, this guy was pretty good, and he did a good job with our other property. That was the one that we sold for about a 9% IRR to our LPs. And he couldn't do anything with the property either. And we brought in our asset managers, our boots on the ground partners that I mentioned before, that there were two partners that were in the deal. They didn't find the deal. They didn't raise capital. They were only in the deal to manage the asset, right? So they were the GPs that were responsible for the performance of the asset. So they went in and like helped the property manager find tenants. They went to, the rent assist charities in Columbus. They did a lot of work. They couldn't make it work. So then we brought in a third property manager that we loved and ended up like showing that he was giving everything he had. We even had signs made. We did everything we could to the buildings, and we just couldn't get the rents. We could not turn a profit. So
when you saying you can't make it work with one, another one,
we were losing money every single month, Alex.
But you couldn't fill the place,
yes.
Or it was turnover evictions,
yes.
Or they just simply didn't pay?
Yes.
Is it all together?
All of it. And we couldn't get new leases to the levels that we needed to get them to. Yeah, so I mean, we had crime. We had a common entryways, which is a no in Class C, especially because then you have hallways that stink and have trash and garbage and other crap, literal crap that show up on the walls and the floor. Like it's a mess. And I didn't know that we were getting into that. And so I couldn't convey to our investors, and our one investor in particular, that this was all going to happen. I didn't know this was going to happen. This was our first deal, dude. And I was underwriting this was our first live deal. I'd underwritten a lot of deals, but this was our first live deal that I was like stress testing in a real life scenario. And like, it went bad, man. It went bad on lots of different deals. So you asked why it failed, how it failed. That's how it failed. We couldn't get it to turn a profit. We had our 5 GPs, 3 of them, I think, or even 3 of them ended up giving loans to the project out of their personal funds to keep the project afloat. And those loans have become a source of contest between our big LP investor and the GP team. So yeah, that's where we are on that one. And there's a lot more to it, but that's essential.
Let's talk about lessons. I think it's important to mention. So once in, right, property manager.
Yep.
What did you learn from there? How do you find a right property manager, and how do you vet them before letting them run the property?
Don't do Class C properties ever.
So it's not about manager, it's about the class of the properties.
Yeah, because when you do a Class C property, you're going to get a Class C property manager. Think about what I just said. Class C property manager. Like that's a real thing. If you're a good property manager that knows what the heck you're doing, you're not going to take a 70 unit Class C 1970 value add fixer that's going to be full of unemployed people. Right. So we couldn't find anybody to manage the property for, even though we had our boots on the ground asset managers that were supposedly getting paid to make sure this thing performed. They did go to work. I'll give them that. But like the property couldn't be managed. And we found that with our other Class Cs too. It's not just this one. So our buy box does not include Class C value add anymore.
Okay, I accept that. I understand. But there is also Class C properties in the good area, right? So is it the area underwritten is more important than the class of the building?
Yeah, I mean, yes, the area. So, I mean, to cut to the chase on that one, you have to do your research and due diligence on crime. So you have to know at a property level what's happened there in terms of crime, and you have to know at a sub-market level what's happened in terms of crime. And that's going to that will tell you the story. Yep.
So when you underwritten this particular property, I understand it's the first one and sometimes mistake making, and we know what happened. But did you look into crime maps and neighborhood scout for this particular one, or you drove by and you feel like it's okay and you just went with that?
I honestly don't remember. So I would say this. If I was betting, I would say no, we didn't check crime because that wasn't something that we knew to do back then. And this, like, I'm not throwing my coach under the bus or my mentor under the bus. Like, I felt like I was well advised, and I think I was pretty well advised. But in retrospect, dude, the little tiny things that end up killing the whole daggone deal, like, you don't know what you don't know. And this was deal numero uno, as they say here in Mexico. Like, so there's so many things that I didn't know that I didn't know. I probably got 30% better on the next deal, on the underwriting and everything else, because I took a risk. I went big. Instead of going home, I go big or go home. I went big, right? Carl went big. We brought in these partners, trusted them, right? Our investor trusted them, right? They didn't work out, quite frankly. And neither did our property managers. And that doesn't mean they're horrible people, but it means that, like, there's a lot of pain because of it, you know?
So how do you fix it? I mean, you get referral from someone that you know, especially if you're new to the space.
Yep.
And for our listeners who just started multifamily journey, they gotta ask people around, hey, do you know good real estate attorney to help us with the paperwork? Because it's one of the important things, right? You need to cover your career, make sure everything is set in stone, and you at least you can continue this journey even though everything carries risks, right? So how do you avoid this in future? And how do you recommend avoiding it for our listeners?
Well, it's a different time now, dude. I mean, you literally have, like, you have ChatGPT, but then you have Perplexity. And Perplexity, I know if I go to Perplexity and say, you know, give me the top 3 Class C property managers that could handle a 70 unit in Columbus, Ohio, then I'm going to get a pretty good answer to that, right? That didn't exist back then. So you're talking about what I would do now with the experience I have now and the tools I have now. It's irrelevant to what happened back then. So that's a caveat. So what I would do now is, look, the conferences weren't what they are now. Best ever. You know, there's groups like Raise. If you're a capital raiser or a fund manager, there's masterminds and group masterminds like Hunter Thompson's Raise Masters that I highly recommend, unsolicited. Hunter and I are acquaintances. I love Hunter. I think he's an awesome dude, but, like, he's not paying me. And you know, there's proven ways of doing things that have proof of concept, that have long track records, and there's people and companies that now have 5-year track records that didn't have 5-year track records back then. I would say the larger conversation here is how the heck do you raise capital for these deals, right? Like, if most listeners right now, in my opinion, are probably, yeah, they're listening to the dark side of syndication, or like what can go wrong on deals. I mean, I could tell 3 more stories about 3 more properties that have gone bad, and all 3 of those we still own and they hurt. But I think the harder thing now is interest rates are still high. They haven't come back down to where they were. And LPs, limited partner investors that invest in your deals, that fund the equity portion that you need to get these loans, they're not nearly as willing to invest because they've either lost money, some of them have lost everything, or they're not getting paid a preferred return like they were promised. And they don't realize how lucky they are to have not lost the deal, but still they don't appreciate that they're not getting paid like you said, Tate, that they would, right? So, or I didn't say they would, but I said, we project that you will get paid this amount, that our projections show that you will get this, right? So it's a tough time, man. It's every capital raiser on the planet, especially in the United States, especially in real estate, especially in commercial real estate, will tell you that raising capital at an LP retail level right now is a bitch. I swore. I promised myself I wasn't going to swear. But that wasn't real. It's a bitch, dude. It sucks.
But hold on, before we go into capital raising, I mean, it's a problem of nowadays. I want to just a few more questions about the dark side of syndications.
Sure.
At what point do you decide and you start questioning, is it worth to continue when is a breaking point that you're like, okay, we have to sell it? It's a good money off the bat. We cannot continue raising funds. And was it a mistake to get additional source funds from GPs? Hindsight 2020,
Good
but
question.
would you do?
Well, in real time, dude, this is a linear, right? So like you've got, 1 month you're missing, you're short $5,000. The next month you're short 10 grand. The next month you're short 2 grand. So you're losing money every single month and you don't know what's coming. So at that point you're like, okay, do we throw money in as GPs to protect our investors? Right? Because that's the real conversation. If we sell now, we're not going to sell it for enough to either get the returns for our investors that we promised them or projected for them, or they're actually going to take a loss and they're not going to get all of their principal back, or in some cases they might lose everything. Like that's not something that is basically what we faced with that first deal. And we had to sell it because we didn't have more money to pump into it. Right? As a GP, we had pumped tens and tens and tens of thousands of dollars over the course of a year and a half, 2 years plus to keep that deal floating. And those guys were making money on the money that they loaned to the project, right? But when you do that, you have to properly disclose and you have to do things by the terms of the PPM and the operating agreement, or you're in trouble. So that's a thing right now that we're dealing with. Anyway, so how do you make the decision? When you're out of money, or when you say, look, investors, we're making the best call we can right now without being able to have a crystal ball and tell the future. But we feel like the best thing to protect what you have left in this deal is to get out now, and you're not going to get as much as we projected.
So Tate, I mean, it's very hard lesson, and I think you handle it pretty well so far. But tell me, how did you communicate with investors and with other GPs? How quickly it comes from point A to point Z? Point A, we're trying to cover up, we're trying to still to work it, and point Z happens, we have to sell it, we're gonna go bust.
Well, yeah. So ideally, you're sending out quarterly newsletters to your investors at a bare minimum, right? And when things start to go sideways big time, you should be having like live calls or webinars with your investors about that. That's how we should have handled it. That's not how we handled it. We didn't communicate well. We brought in a sixth GP that ended up being the connection to this LP investor. That was the condition of him joining the deal. And we basically communicated through him to our investor. He was our personal liaison or communicator to that investor. And now that 6GP was not necessarily communicated to as thoroughly as he should have been. But in a general LP structure, when you have 6 LPs or 30 LPs or whatever, then you're doing regular communication with financials. You're sending them the financial, not the reports necessarily, but in the newsletter, you're summarizing the financials. You're updating any and all pertinent items, performance, everything else, CapEx, and you're providing them with any updates on financing, debt, like are you refinancing? Are you trying to refinance? Are you preparing to refinance? And if you're not paying a pref, you need to explain why. Or if you're paying a partial pref this quarter, you need to explain why. This is all stuff I've learned since that deal, Alex.
But it doesn't happen. June, everything's okay. It's fine. In July, we have to sell it. It doesn't happen within a month, right?
No.
It gradually comes to that point.
It was a 2.5 year decline. Yeah.
Oh wow.
Yeah. Yeah. It was painful.
Okay.
It was as painful as it gets, man.
Now another big question
Can you
in the room, right?
Can you hear the tears running out of my eyes?
Yeah, I can hear it.
I'm not making light of it. It sucks. Losing an investor's money, dude, like whether it's 10,000 or 800,000, no bueno. It's painful. And that follows you too. Like that's not something that you can hide or should hide even, right? It's just there's no two ways around it. It sucks.
One last question about this particular first syndication. Why did you have to bring an outside asset manager to the deal? You didn't know how to do it, or you just were too busy with other stuff? What happened on that level?
Great question. We were investing out of state. and we needed local boots on the ground on our team. Quite frankly, just for credibility, just for like practicality. They knew the market. They knew who to hire if faucet went out, and we trusted those guys. They came to us. They heard about us doing deals in Columbus. They cold called me and said, "Hey, we'd love to connect with you and build a team with you and like do deals with you." And I said, "Okay, I've got the 2 deals that I'm working on. Let's look at them." We did 2 deals with these guys. We trusted them, and things went really, really sideways with them. And I don't have a lot of good things to say about any of it. And that's just how it is, man. Like there's things in business that don't go well, and people get on opposite sides of issues. I'm being as diplomatic as I can here. And people don't treat other people the way they should be treated. And that's something that I'm 52 years old, man, and I keep learning. Like I'm learning all the time. I'm always learning. I'm coachable as hell. Like I'm learnable as hell. And and by the way, for 5 years, 6 years almost, I've had a podcast about all this where I talk in depth about all of these issues all the time. So the Apartment Gurus podcast is on Spotify, it's on Apple Podcasts, and it's on my YouTube channel. And so you can go hear about any and all of this as much as you want. There's nothing to hide here, right? I want to make that super clear. Like at no point did I say this is going to cost $4,000 a unit, but I know it's actually going to cost $8,000 a unit. I've been accused of that, right? I've been accused by GP partners of understating a CapEx budget to enroll an LP investor. I've been accused of that. I didn't do that. I never would do that. Why would I do that? Why would I set myself up for failure and say that we're gonna do renos for $4,000 a unit, but hey guys, it's gonna be $8,000 a unit. But let's just get this investor in and get the deal done so we can get our acquisition fee, and then we'll figure it out. No, that's not what I did. And so like whatever. But and at the end of the day, Alex, sometimes you just gotta like pick up the pieces and keep going.
I have few follow-up questions on that. One is, did you do due diligence on those guys who you brought to the team right away? Second, did they give you opinion on the area, the local boots on the ground? So I would expect them to guide you through this area since you're not in the area. And number 3 is, did they give you any feedback on the CapEx? Because if the locals, they know it costs more than that, did they give you a proper feedback? Okay, this is a good amount or not good amount. I would figure out you're gonna bounce those ideas with them. Did you do that, or they just all been boots on the ground after all?
Yeah, great questions. Did I do due diligence on them? Yeah, I did. They were experienced guys in the market. They had done a few of their own deals. They were firefighters for the city of Columbus. They were both getting ready to retire from the fire department due to their success in real estate. They had a great social media presence. One of them did. And I flew out there and met them and talked to them and liked them and trusted them. And we built a friendship, right? Well, yes, I did due diligence on them the best I could at the time with what I had. Did they give me a heads up that area wasn't growing? No, they didn't, that I remember. I don't remember them saying, Tate, this area is not growing at all. It's stagnant. Or Tate, this area has a lot of crime. It didn't really have a ton of crime, but like, I don't remember them going, hey, Tate, we're not going to do this deal because we don't like it, because it's in an area that's not growing. I don't remember them saying anything like that. So, yeah, no. And then as far as the third question, CapEx, no, they didn't. They reviewed they had the numbers. They signed up for this deal. They signed the PPM. They signed the operating agreement. They signed the legal docs. They had my numbers in front of them. So they signed up with my numbers. And did they ever say, Tate, we don't like this CapEx budget? I don't remember. I don't remember them saying that. And I also don't remember them. There was probably some conversation around like, hey, we might need, like, this CapEx budget is probably not like hard and fast. And we might need to like maybe bring in some, I don't even remember if we talked about bringing in more money, but like, we're like, but no, did they tell me that the CapEx budget was going to double? No, they didn't. And By the way, when it did double, when we were on the call with the investor telling him that it doubled, I took the heat for it because I said, look, this was my underwriting. I got it wrong. My projections were wrong. And that was the truth, right? But I took the heat for the team and those guys didn't. And I wasn't the expert in the area that should have. And I also wasn't the asset manager. So those guys were managing the asset. That was their only job. They didn't find the deal. They didn't raise capital. They didn't even try to raise capital, dude. So, no. Does that answer all three of your questions?
It does.
Yeah.
So what do you do differently nowadays on your later on acquisitions?
Well, you just try to pick better partners or you do it yourself but then at that point you need to know what the heck you're doing, right? And being a lead sponsor is no joke, man. Being a GP is no joke. Being a lead GP, when you're the captain of the ship, doing the deal, finding the deal, negotiating the deal, writing the LOI, walking the deal, doing the due diligence, finding the guarantor, finding the lender, reviewing different lending quotes, getting the insurance done, blah, 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 blah. This is what I was talking about, that whole LOI to closing book idea that I have. Somebody needs to do a guidebook that takes you from, hey, I just wrote an LOI that got accepted, to, hey, I just got the keys, or my property manager just took over for the other property manager that used to manage the property, and I now own a 100-unit apartment building. What happens between those 2 points? That's like there's a book to be written there because it's a big deal. And in my opinion, the only way to do that ethically is to be properly guided by a professional that you're paying to guide you through the process. In a lot of cases, that can be a broker, because brokers like know what they're doing. But guess what? The broker's working for the seller. So you as a buyer, as a new investor, you need to have some expert in your corner that knows what the heck they're doing, that's made tons of mistakes, that's learned from those mistakes. Because when you hire a coach or a mentor or a consultant or a guide or whatever you want to call them, you're leveraging their experience, you're leveraging their knowledge, you're leveraging their expertise, but you're also leveraging their failures. You're leveraging their mistakes because they've made the mistakes that you're not going to make, right? And now, is it worth paying somebody 10 grand a year to do that? To make, to buy a $10 million apartment community, even if you just buy one? What if you want to buy 5? Is it worth paying somebody 15 grand a year? So that's
even if you avoid one mistake through the whole journey, it's still worth any penny, right? Just
right.
One mistake can tank the deal, so it's inevitable.
The legal budget on these deals is $15,000 just for the SEC attorneys. So you're paying your SEC attorney to write the documents up. They're professionals. Why don't you hire yourself for $15,000 for 6 months or a year, a coach that knows what the heck they're doing because they've been in the trenches, they've been in the weeds, they've fallen on their faces, they've partnered with the wrong people, they've gotten the bad loans, they've seen the worst of the worst of the worst of the market, they've seen interest rates go up 500%, right? And like, why would you not do that? Why would you put your investors in a position? Why would you raise capital without having the right coach in your corner, right? The right mentor, whatever you want to call them, the right consultant, even if it's the right partner. If you're partnering with somebody that knows what the heck they're doing, I partner with my clients, I coach people, and I will partner with them, right? So yeah.
So the only thing I don't understand, so you already got some experience from flipping and running small multifamily. Why completely give control asset management to someone else? Why didn't you want to be part of that asset management crew? Why do you have to do the entire asset management?
Quite frankly, I don't give asset management away to everybody. I'm on every asset management meeting. I am a GP. I own X percentage of every deal, 20%, 25%, 18%, 12%. I have as much say as anybody on the GP in terms of asset management. Yeah.
But you didn't see that coming as an asset manager, or you were just there, boots on the ground, so you couldn't really do anything with that?
What do you mean? I didn't see what coming as an asset manager. Well, first of all, I wasn't an asset manager, but go ahead. What didn't I see coming?
Right, you weren't an asset manager, but you were part of the GP, right? So you weren't the calls. So it just so the problem was with this particular, we have bad area, we couldn't turn things going on. So basically, all those mistakes could have been avoided in the inception. So if you have boots on the ground, proper boots on the ground guys who would guide you, say, listen, don't touch this area. We would personally touch it because this is good. So
Right.
this is what boils down. And any asset manager would probably couldn't do anything with it because it's just tough product. It just not, you just can't really do much. You see, for me personally, I was involved in the deal. I was a minor partner and it also went south. And for me, main learning question was I didn't have any control powers there because I was such a minor partner. And for me, giving out this control, it's just no for the future deals that I'm gonna do. I will still continue this journey and I will still try to mess to it. But in my experience, this control powers couldn't, I think I have more ethical going on, behavior to actually do few things right. In my syndication was a little different story, and we had first 6 months completely mismanaged on my side, but it's a whole nother podcast. I'm not gonna dive deeper into
Let's
it.
do it, man.
But
I will bring you on my podcast and we'll tell your let's do it. I'm serious. Let's do this. Next week, we're going to do Alex Kononov on the Apartment Gurus telling the dark sides of syndication.
we'll schedule it for sure. But yeah, it's still a sensitive topic. But I feel like everyone has those stories, and you just it's not how many times you got hit, but how many times you stand up,
Yeah.
learn from your lessons, and
Right.
move on with this product and try to make a good side of it.
Yep.
Listen,
Hey, can I say something?
yep.
If you're going to bring in a partner, boots on the ground partner, to know neighborhoods and know submarkets and to know CapEx budgets and to know construction, wouldn't a firefighter be a really good candidate?
Oh yeah, local,
A firefighter that
connected.
has had multifamily experience. Like I think I actually chose pretty well, and I got what I got, man. Like, and here's the thing in life, Alex. Like, there's things you can control, and there's externals you can't control, and that's the truth in multifamily. It's the truth in investing. It's the truth in life. As a man, as a person, as a human being, there's things that are under your control and there's things that aren't. And I'm not a victim of any of it, by the way. Like, that's a whole different conversation. These guys, like, whatever. I'm not a victim to them. Like, I went through a lot of pain, and I'm continuing to go through some pain because of choices that they've made that I didn't have control over. But like, at the end of the day, like, I feel sorry for those guys. I really do, because we were building something big in Columbus. And we've since done some big things in Columbus. And we've had some other big things go bad in Columbus too. We've lost a couple deals that sucked. Not when I say lose, I mean we had them under contract and didn't end up buying them and lost due diligence cost and earnest money. And this was continual problems from the interest rate crisis, right? And that's another podcast episode. But back to this particular deal and this particular partnership and how things went so sideways, you have to be able to look at a situation and say, look, did I do my best? Yeah, I think I pretty much did. You know, did I make a lot of mistakes in retrospect? Yeah. Did I get underwriting wrong? You betcha. Did I get a CapEx budget 50% wrong, 60% wrong, 40% wrong? Yep. Did my partners also get it wrong? Was I the only GP reviewing the CapEx budget? Did I lean on them a little bit for help? Yeah, I did. I trusted them. I trusted those guys, and they were not worthy of my trust. And that's what's proven to be the case as things have unfolded, right? And there's another property that we bought together that has bigger, badder, darker stories that we could do another whole episode on, and maybe we will someday. But that said, like, yeah, at the end of the day, I think the best point you made, Alex, the best thing that was said here is like, you can't lose if you get up, right? If you fall down and you get back up, you don't lose. You can't fail if you get back up. If you fail 10 times, you get up effing 11 times, right? So you can bleep that and pretend that I said the F word. But like, that's what you do, man. That's an entrepreneur. That's gut. That's grit. If you're an entrepreneur, you eat what you kill. You eat what you kill. And that means that you take risks, that you take responsibility, that you take accountability, and that at the end of the day, like, there's nobody coming to save you. There's nobody coming to save me, and there was nobody coming to save that deal, and there's nobody coming to save those guys in the situation that they're in right now. And that's fine. I wish I wish everybody the best. I wish our LP investor the best, and I'm going to do everything I can to like make things right by him the best I can with the limited resources that I have and I have 20% of that GP. There are 5 of us. Actually, sorry, there's 6 of us. So I'm not even sure what the percentages ended up being, but it was originally it was 20, 20, 20, 20, 20, 5 ways. And then we brought in the 6 GP to bring in the investor. So I can't remember how that all went down in terms of the splits, but like,
It doesn't matter. At the end of
yeah,
the day,
right.
it happens what it happened. But listen, Tate, you got a ton of experience from failed to successes to wins. And so what are you doing nowadays?
Yeah.
For your company, Greenlight, and in general?
I appreciate that. Yeah, and you know, there were 13 other deals, right, that came along, or 12 other deals after that, and we still own 8. I might be wrong on the 12. I might be a little high on that, but we still own 8 properties. We've weathered the storm on most of them. We are doing everything we can to make sure that our investors' best interests are protected best we can with everything we know and all the mistakes we've made going into a very uncertain climate right now with leadership and tariffs and blah, 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 interest rates and the Fed and who's going to lead the Fed and is the Fed chair going to get fired and what's going to happen to interest. I mean, we're doing the best we can with all of that. And what am I doing now? I coach a couple multifamily investors still inside of the multifamily space, and I coach men, dude. Alex, my vision for men is that men in their 40s and 50s that are stuck in a soul-sucking job, corporate executive, maybe, and they're probably like really good at what they do. They're like VPs, or you know, they maybe they own the company even, right? But it's they're in the grind, you know. I coach those guys. And I help them level up and find their purpose and their mission and get on point in their lives, in every part of their lives, because you can't hide, you know, like if one out of the 7 parts of your lives is a 0 and the rest are 100, that 0 is going to cause a lot of problems, or 10 or whatever it is. So basically I am a life coach. But I coach elite entrepreneurial men in their 40s and 50s that want to go big and live a life that they're head over heels in love with living. And that's what I do.
Is it one-on-one coaching, or you have mentorship group?
Yeah, I have. It's primarily one-on-one coaching, which isn't the most efficient coaching model. The group coaching is the big phenomenon right now. I'm going to do a group. I'm going to do a group that people can join, and it'll be pretty big. And the nice thing about big groups is then you have a network, right? Your network is your net worth. You hear that all the time. Well, if you're in a mastermind, a group coaching mastermind that meets every week with, you know, Alex Kononov is the leader and the guru, or Tim Bratz or Tate Siemer, right? Then you know those people. They're like your family. And those people know people that can help you. So like Raise Masters, for instance, when we were raising capital, and you know, when we were actively raising capital, Raise Masters was a gold mine, because there's 400 other capital raisers in there that all know LPs, that all know sponsors, that all know GPs, that all know blah blah blah, insurance agents, property managers. Like, that's how you do business, is relationships and networking, referrals. And you got to be good at the people business, man. And probably everybody listening to this already is. That's just a given. Like, you got to be good with people. You got to be able to connect, make friends, have a good time, tell some jokes, drink
You know, I
beer.
think would be,
I don't
as
really
you know,
drink.
I think would be good. I see a lot of your personal photos, because we connect on social media,
Yep.
outside and outdoors. And I've seen this mastermind in Montana, is focused on outdoors for lead entrepreneurs, and they network and they spend time outdoors, like go hiking for 7 days or something like this. That would be a cool idea for mastermind. I'll
Yeah,
be
I love
open
that
to
idea.
join.
Yeah.
You just collect group of, you know, specific network, specific kind of level, and just go remote, no phones, nothing, for a week, disappear
That's a great
and put
idea.
on stop.
We do in-person events in Mexico, where I'm living right now. So my guys are going to come down in November. I've got a small group there's 5 of us that are like now we're 5 best friends, but we basically been a networking or a mastermind group that I lead. It's my group. And I'm living in Sayulita, Mexico on the Pacific coast, little hippie surf town north of Puerto Vallarta. And those guys have all been here. We've done 2 events already here. One guy in the group hasn't been here yet. And they're all coming in November. And we'll do some crazy stuff. We'll do some fun stuff. We'll do some partying. We'll do some surfing. We'll do some personal development work. We'll do business development work. We'll do breath work. We'll do cold plunges. We'll swim in the ocean. We'll go hiking. I don't know if we'll turn phones off, man. We're phone addicts. So I don't know.
Everyone is, but I think it's important to put life on hold and just be focused on yourself.
Like, you gotta create that content. Can't turn your phone off.
Yeah, sure. It's definitely a challenge, but it's a good one.
Yeah.
Listen, Tate, I only have a few questions for you.
Yep.
So quick hits, lightning rounds, or whatever comes first to your mind, let us know.
Yep.
One book or resource that changed your real estate mindset.
The Untethered Soul by Michael Singer. It's not a real
That's
estate
a new
book.
one.
It's not a real estate book.
I mean, real estate is a business, so your mentality on operating and living life.
You want a business book? Here's why I said The Untethered Soul is because you said a book that changed your life. Or you said a book that changed something, and I just went, The Untethered Soul to me is like, it's irreplaceable. And so is The Power of Now, by the way, by Eckhart Tolle. I had all my guys in my mastermind read that for our first event. I'm a mindset coach, man. And like, so for me, like I coach the whole man. I call it the whole man method. And so like, business book. Bo Beery he's a broker in Tampa. He has a book
I get his emails too.
Relations called How to Dominate. The subtitle's How to Dominate as a Multifamily Investor. And I can't remember the name of the book, but I give it to every single one of my clients. That's so funny. I can't remember the name. Multifamily Investors Who Dominate.
Who dominate. I have it. I listened to Audible.
Yeah. Bo Beery, Beery, not Barry, Beery. And he is a great dude. He's been on my show. That book is a how to build relationships with commercial real estate brokers. And it's a gem. It's a short read. I give it to everybody that I've ever coached has a hard copy of it. And I probably have 10 copies of it in my storage unit in Utah.
Love it. Okay, let's move on to the next one. Most important trait for someone trying to lead in a syndication business. Let me run it. So the most important trait for someone trying to lead in a syndication business.
I mean, this is going to sound like a cliche, but integrity, man. And the way that I use the word integrity is it's not about right or wrong. It's not morality. It's not about did I do the right thing. It's about did I do the thing that worked? Did I tell the truth? Because the truth works. Telling lies does not work. Not disclosing on a PPM doesn't work. Not disclosing in financials doesn't work. Skimming funds off of an operational budget doesn't work. And not telling your investors about it makes it even worse. Integrity.
I think it's important because it's so hard to build a trust, but to lose it, it's just like this.
Once
and when you lose it,
gone, man.
It's gone.
The way people see you, like they love you until all of a sudden you show them that you're not worthy of their trust for whatever reason. And that's usually some form of bending the truth or not telling the truth. And I tell the truth, man. I tell my friends
because one way or another, if you're lying, you at some point you're gonna slip and it will be noticeable like this. And you can just lie forever. And you just one way or another. If you just say truth, it's just easier. You sleep well, you say truth.
On social media, like the way AI is gonna, like 10 years from now, the way it's everything that we've ever said, done, published on social media, written, texted, will probably get reviewed at some point. And if you lied or did something unethical or forged a signature or whatever, it's probably going to get discovered. So by far the most workable way of doing life is to tell the truth and have integrity, which, and again, for me, integrity is synonymous with workability. It's not morality. It's not right or wrong. It's not bad or good. You're wrong for doing this. You're shameful. You should be guilty. You're judged. Like that's not what it's about. It's, does this work, right? When I build the Golden Gate Bridge, is there integrity in those 2 big old posts that go up, those towers? Is there enough integrity in those posts to support the bridge?
100%. Okay, one last thing. One thing you wish you knew earlier in your investment journey.
I'm just going to say this because this is my MO. It all works out. It really does. It all works out. And deals go bad. You lose everything sometimes. I've lost a $500,000 earnest money deposit, right? That hurts. I'm still here, man. Like you and I are talking, Alex. I'm helping people. I'm starting a new podcast. I'm coaching people. I've got my dog, my 14-year-old dog, Joey. Like he's still with me. I've lost a lot. Like the last 2 years have been hard, man. Like the path of having properties that, you know, we acquired 80, almost $100 million. We almost got to 1,000 doors. We didn't get to 1,000 doors, but we got really close. And we probably got to really close to 100 million when the valuations were high. Going from that to having properties devalue and not perform and suck capital, and then to lose a couple of earnest money deposits and due diligence costs causes a lot of pain, even if you're single and without kids, which is the case with me. Yeah, I'm probably an optimist to a fault. Like, so I could be accused of that, but my evidence of 52 years is that things work out in the end.
Yeah, love it. Okay, Tate, one last question. If someone want to get to know you, follow along your journey, and maybe a new masterminds that you're going to launch on wilderness journey, where people can find you?
Let's just go Instagram, man, at Tate Siemer, TateSiemer. I'm on LinkedIn, very active. I'm on Facebook, very active. You can text me, you can email me, but you know, everybody says, and I say, give them one point of contact. I've got, you know, my coaching funnels that you could go find. Google me if you want, but at Tate Siemer at Instagram. I've got a lot of drone footage. I'm a drone photographer. I take aerial footage of Sayulita down here, ocean, waves, surfers, jungle. Like, I'm a pretty good follow, I think.
Yep, love it. Tate, thanks again for coming today.
This is awesome.
And for keeping it real with us. Really, the conversation was packed with hard-earned wisdom. And I know a lot of our listeners will resonate with your honesty about the ups and downs. And really appreciate you sharing your journey in such details and being vulnerable with us to go into details, how it happened and what lessons we learned from here.
Dude, I appreciate you, Alex. That's all I got to say. Like, this was an incredible experience to go through this with you, with our friendship. I really hope that good things happen because we did this, and I hope your listeners get a lot out of it.
It will happen, and especially I think we share those lessons with our listeners, and hopefully we can help everyone to avoid some similar mistakes in the future and be up. And don't forget that it's not the end of the world if you keep pushing and keep driving the force behind you, and make sure you still want to succeed in this life. Nothing is the end until it is the end.
Yeah.
And
it's not
listen,
supposed to be easy, man. This is not, life is not, nobody said life would be easy. Like,
for sure,
you know,
for sure.
Should it be? Like, wouldn't it be kind of boring if it was easy?
They would get experience. Even if it's bad, it's still experience and gonna make life better.
Yeah.
Listen, again, thanks, Ted. And for everyone who's listening, if you enjoyed this episode, don't forget to like and subscribe and leave a review, and follow us on social to catch the next story of progress. Until next time, stay focused and keep moving forward.